All right, today we're jumping into the wild world of penny stocks, and we're going to deconstruct a popular trader's analysis of a company called GPUS. Now, this stock was thrown into chaos after a major, really sudden announcement from the company. It left a lot of traders scratching their heads wondering what to do. So we're going to break down this one analyst's take, piece by piece. And this is the big question, right? The one on every trader's mind. Is this huge price drop a golden opportunity to buy the dip? Or is it a giant red flag telling you to get out now, to abandon ship? The analyst we're following tries to answer that exact question. And his journey from, being pretty optimistic to extremely cautious, well, that's what we're going to unpack. So here's how we're going to break this down. First, we'll look at the analyst's original prediction from back in November. Then, we get to the bombshell announcement that just changed everything. We'll dig into the key financial concept here, dilution, and then see what his new forecast for the stock is. And finally, we'll look at how his analysis pivots into a pitch for his private trading community.
Okay, so to really get what's happening now, we have to rewind the clock a little. Let's go back to November 20th. This is when this trader first laid out his pretty bullish case for GPUs.
Back then, the stock was hovering around that 20-cent mark, and his view was pretty clear. He was optimistic. He didn't see this price as a danger zone, he actually saw it as a really attractive spot to get in for a potential bounce. He was thinking, better days were on the horizon. But he attached one very specific and, as it turns out, very prophetic warning to that call. And this is where he really hit the nail on the head. He put this huge condition on his bullish prediction. He basically said, look, this can recover, but only if the company avoids shooting itself in the leg with dilution. And that one word, dilution, is about to become the most important part of this whole story. And that brings us to the moment that completely flipped the script. The company went and did the one thing the analysts warned them not to do. They announced a massive, at-the-market equity offering. His reaction? It was instant. It was crystal clear. All that optimism from November? Gone. Replaced with this. The stock tanked about 15% in after-hours trading right away, and his entire theory about the stock had to be thrown out and reevaluated on the spot. So what exactly was this news that caused such a panic? The company announced they were going to raise up to $50 million. And how? By creating and selling new shares of its stock directly onto the open market. Now, for a tiny company with a market cap of around $83 million, raising $50 million is a huge deal. That is a ton of new shares getting ready to flood the market.
So just to make sure we're all on the same page, an equity offering is just how a public company raises cash. They essentially print new shares out of thin air and sell them to investors. And while, this gets them the money they need, it has a major side effect. And that side effect is the absolute core of the analyst's new, much more pessimistic argument.
See, according to the analyst, the problem isn't that the company is raising money, it's how they're doing it. The whole issue boils down to the most basic economic principle there is, supply and demand. He explains it really simply. Think about it. When you've got a limited number of shares out there, that's low supply, and a whole bunch of people want to buy them, that's high demand, what happens? The price gets pushed up. It's natural. But in this new situation, the company is creating a massive new supply of shares. And this is the heart of his new argument. He says it doesn't matter if a wave of new buyers rushes in to buy the stock, the company can just meet every single buy order by selling them new shares from that $50 million offering. So all that buying pressure that would normally shoot the price up, it just gets soaked up by this massive new supply. The price is basically pinned down. So given this new reality, this huge cloud of supply hanging over the stock, what does the analyst think is going to happen next? Well, his updated forecast is a multi-step journey, and it starts with a little more pain before we see any potential light at the end of the tunnel. He sees this playing out in 3 phases. First, he expects more downward pressure on the stock in the short term as the market digests this offering. Second, he's convinced the company will have to announce a reverse split. That's when a company will, say, turn every 10 of your shares into one new share, but at 10 times the price. It doesn't change your total value, but it gets the share price up to avoid being kicked off the stock exchange. And only after that happens, he says, can the real road to recovery even begin. And here are the numbers he's putting on it. In the short term, he could see a bounce back up to around the 30-cent level. But his bigger, long-term target is a retest of 80 cents. But, and this is a huge but, he is absolutely clear he believes that 80-cent target is only possible after a reverse split happens, not before. And right here, this is where the source material takes a very sharp turn.
After laying out this pretty complicated and frankly difficult road ahead for GPUs, the analyst pivots. He goes from market analysis to a direct sales pitch. He starts presenting a solution for traders who are, in his words, tired of losing, his own private paid trading community.
So what's inside? Well, the community is pitched as this all-in-one solution. It promises specific alerts for all kinds of trading, day, swing, and options. A really big selling point is the access to mentors, who he describes as seven-figure traders, and even practical stuff, like how to size your positions if you have a $10,000 account.
And of course, to get people in the door, there's a special offer on the table. It's a 50% off holiday deal, a 2-week free trial to check it out, and a 30-day money-back guarantee, which he makes a point of saying is something other communities don't usually offer.
He then moves into social proof, showing testimonials from members. This first one is from a user who was brand new to options trading, which kind of suggests that the service is good for beginners who are just willing to follow the alerts they're given. And this next testimonial really doubles down on that theme of trust and just relying on the community's leaders. This person says they've learned to be humble and just follow your lead, basically saying that if they tried to trade on their own, they'd lose money.
And finally, we see a range of alleged profits from members. The results shown are all over the place, from a solid 15% profit all the way up to an absolutely mind-blowing 49,000% gain. They also show specific dollar amounts, which seems designed to show that both big and small accounts can supposedly do well in the group.
So let's just pull this all together. We saw an analyst make a prediction that was spot on. Then we saw him completely pivot his entire thesis based on one single action from a company. And then he used that whole analysis as a jumping-off point to sell a product. This whole sequence leaves us with a really important question, not just about GPUs, but about all the financial content we see online. How do you tell the difference between genuine analysis and what's really just a very sophisticated advertisement?